Welcome to another session of Informally Formal. Our today's topic is credit rating and its importance. We have two very important people joining us today. The first person that I will introduce is N.K. Mobin. He is the Managing Director and CEO of Emerging Credit, one of the leading credit agencies in Bangladesh. Moreover, he also serves on the board of several companies, and also currently is the Senior Vice President of Dhaka Chamber of Commerce and Industry. Even though today he comes to us in his capacity as the Managing Director and CEO of Emerging Credit, which is our topic of interest. The second person is Sayaqua Moslem, an upcoming star in the credit rating arena. She's the Chief Rating Officer for Bangladesh Rating Agency Limited, also called BDRAL. So welcome to both of you.
Thank you.
Thank you very much. All right, we'll dive right into our first question, and I'll direct it to Mobin. Explain to our audience as to what this credit rating and why is it important? What is it all about?
Credit rating is practically an independent opinion on the ability of any business houses or a government to repay its debt obligations on time. Credit rating is a little bit new in Bangladesh and also not very popular to the general people. Credit rating is mainly targeted for the bond market in all over the world. But in our cases, in our country, it is also catering the loan rating of all the commercial banks in Bangladesh.
Is to independently assess the debt repayment capability of an organization or an institution or a country. I would like to ask Sayaqua now to give us a brief overview of the three big rating agencies in the world. Over to you, Sayaqua.
Thank you very much. So there are, as Mr. Mobin mentioned earlier, there are three, we call them big three companies, three rating agencies in this world. That is Standard & Poor's, Moody's, and Fitch. So these three companies has 95% of the market share of the total credit rating industry of the world, and they rates the bonds as well as they are into sovereign rating. And S&P has the highest market share of 7 billion, followed by Moody's with 4.5 billion, and lastly Fitch with 1.8 billion. There is a rule in Bangladesh that we have to collaborate with the external rating agency. So in most cases, we are working with the subsidiaries or partner companies, local partner companies of mostly Asian partner companies of these three companies.
Okay, wonderful, wonderful. Mobin, would you kindly care to elaborate the rating scheme? And I know they give a letter rating, right? Would you just very quickly tell us the letter ratings and what do they mean?
Credit rating is some way 360-degree evaluations of any business, mostly on the area of business risks, financial risks, and some other risks associated to the industry. With all the facts, data, whatever we collect from the companies on those areas, we plot into those in the score sheet, and that score sheet has around 70 to 80 questions, and that scores, every question has a band, so 0, 2, 3, 4, 5 or something, and then all scores is compiled. Then that compilation scores against each compilation numbers, there is an alphabet is assigned. This is the total mechanism we are following, which is pure international, and these are already approved by our regulators, which is Bangladesh Securities and Exchange Commission, Bangladesh Bank, and also the insurance authority in Bangladesh. Rating notch is also determined, A+, AAA, then AA minus, AA. All these numbers you'll see all over the world same.
Just to take it a little further, I guess, Sayaqua, I'd go to you. From a layman's perspective, we hear that if it's AAA rated, right, which is kind of the best, and then we hear about ratings that if it gets below a certain level, is considered junk status. Would you care to elaborate on just the rating, the letter rating? Sayaqua?
So I'm going to explain the letter rating of S&P because S&P and Fitch has similar rating and Moody's has a little bit different. So usually the notches are a combination of upper and lower case of alphabets. It starts from AAA and ends with D. So AAA is the highest category of with least risk, least possibility of a default, and from AAA to BBB minus, this is the investable grade. So it is expected that if a particular SSE having a rating from AAA to BBB minus, then that is a an investor or a lender can invest on that particular SSE. And if the rating is below BBB minus, then it's a junk or speculative grade, and in that case, it's not might not be that safe to invest.
I would now like to turn to Mobin again. Mobin, would you care to tell us as to what challenges is this industry facing in Bangladesh?
We have some kind of unhealthy competitions exist among the 8 credit rating companies. Because of that unhealthy competitions, the fee is getting down day by day, and it is now at a very lowest level of 5,000 to 6,000 taka, even less in some cases, which is very difficult with that fee to maintain the quality which is supposed to be provided to any credit rating assignment. In India, the SME rating fee started with around 60 to 66,000 rupees, means around 70 or 80,000 taka in Bangladeshi. So even it is 1/10 in our cases. Because of the low fee we are having in the market, we actually requested our regulators to intervene and fix a floor kind of minimum fee, so that the credit rating companies can really do the assignment properly and up to the standards. But we really need regulator supports on that area through changing the rules and regulations, which was established around 15 years back, which also need to make a revisions in the law.
Mobin, you bring about a very, very important point. And like you mentioned, we have seen it in other industries as well, where if a job requires, let's say, it would cost you 100,000 taka. Okay. Perhaps you can forego your profit and do it for 80,000, but it certainly cannot be done for 50,000. But then there will be competitors that will come in and bid at 50,000, maybe even bid at less than that. It's surely a problem. So Sayaqua, very quickly, what are your views on that?
If a company is trying to offer a credit rating at a lower price, that means it is actually compromising on have to compromise on the quality. It's not applying enough time, enough expert resource for that particular rating. Right. So it's going to affect the quality of the product.
Going back again to Mobin, you mentioned that you guys, the industry has approached the regulators to set a floor. How far is that? Where do we stand on that, Mobin?
In the capital market, there is something already fixed by the SEC, right? The merchant bank premium or charges and all these things already there. So it will not be a new things for them. So they can actually, in line with that, they can also fix the fee for the credit companies. And obviously, I expect if they can do that, then obviously the rating company will be able to provide the maximum quality support to the market.
I would only wish and hope that it happens sooner rather than later.
Right.
Correct. Right. As we have seen, Mobin, you know, Sayaqua, you as well, in the 2008 financial crisis, even rating agencies came into question because we must maintain what is called separation of duties. So how is that separation maintained? Mobin, first to you, and then I would have Sayaqua reflect on that as well. How is that separation of duties, separation of interest controlled in Bangladesh?
Right. Actually, very, very good questions. It is actually because of the regulated industry, this kind of separation is already there in the law. So, say for example, being a managing director of my company, I cannot be part of the rating committee in my company. Number two is that I need to sign a papers telling that on that particular rating company, on that particular company which we are going to rate, we don't have any interest, like we are not holding any shares, maximum number of shares, or we don't have any positions as a director in that company. Bangladesh Bank is also, when they do the audit, they practically check all those things. And also there is the as per securities laws, there is a declaration form which we send to the Securities and Exchange Commissions and declaring that we don't have any major interest in that particular rating assignment.
Right, right. Now, if I were to ask both of you to give me 3 points on what you would want how you would want the regulatory environment to be enhanced, what would those 3 points be?
The credit rating rules 1996, under which we are controlled or we are governed, it's a little bit backdated rules, and that need to be revised based on the current environment in Bangladesh in terms of capital market and also the business environment. So that should be revised, and where obviously I mentioned the fee fixation should be there. Number one. Number two, I think we are somehow having some kind of influence by the external people on our independence. So I think that has to be removed. Like, for example, sometimes in awarding the ratings or without giving a proper documentations, some demand is there for a better rating. So that influences should be removed. And third part, which I must say, is that the Bangladesh Bank is our main, or the major chunk of our rating is in the banks, which is the loan rating, because the capital market is not that developed to do the rating that many by all of us. So here we are doing a very good, we are taking an important role under Basel II conventions, where the bank's provisions required or capital adequacy requirement is determined by the rating. So we must say Bangladesh Bank to monitor that part, not only on us, what we're doing, but also on the bank's parts of whether they're doing it rightly for the whole bunch of loan portfolio. Maybe currently already there is a threshold, maybe below 10 lakhs or below 5 lakhs, it's not rated, but the above a certain limit, based on the portfolio of each bank, practically they should do the rating, and based on that really genuinely calculate the provision requirement against the profit or capital adequacy requirement need for the banking industry.
Right.
So that is more or less the 3 points I mentioned from my side.
Yeah, you bring about a very important point here, and I would go to Sayaqua to ask her what kind of challenges do you see in your work when you're rating the bank's portfolio? Do you face some kind of a pressure, because that rating is directly related to their reserve requirements, so to speak? So do you feel any pressure there? Sayaqua, over to you.
So basically, as we were saying at the beginning of the discussion, that credit rating is independent assessment of repayment of financial obligation of a SSE, right? So when a bank is coming to us to rate their client, they're expecting that that particular company is going to have a good rating, so that they have to keep a lower risk-weighted asset for Basel II requirement. Whereas their perception needs to be like this, that that particular client is going to get whatever rating that particular business entity deserves, so that they can get prepared and keep enough capital, so that if tomorrow the client defaults, they can have enough capital to absorb that shock. So I guess there is a gap in this perception between bankers and the rating agencies. So bankers has a tendency to rate only those clients, those they expect is going to get better rating. So I think in this case, maybe Bangladesh Bank can intervene and make it mandatory to rate all the clients of the banks, loan clients of the banks. In that case, since all the clients are rated, banks will be able to understand the health of their loan portfolio and can keep the required capital for based on the risk they have.
They are not doing the rating of the defaults portfolio. So that is why the bank's real scenario is not coming into the picture if you sum up the whole thing. So that is one point. Second point is that all the default loans we have and those who are being rescheduled year after year, those are treated as a good portfolio in the rating, because the default before the rating starts, then the default is not there because they got the rescheduled copy with that. So they're treated as a good rating. So actually, if that culture is continuous, then practically the rating assignments in the rating portfolio, the real scenario is not coming out.
Very quickly, we're at the tail end, so just to wrap up, we understand, of course, the credit rating mechanism, this industry is critically important. But there are, as you both mentioned, there are several challenges. There is some regulatory, some unfair competition. All of these things needs to be looked at. So, Mobin, just to conclude, what would be then some of your, in broad stroke, very briefly, if you would conclude, what is our takeaway from today's conversation? Over to you, Mobin.
Yeah, I think you highlighted a little bit. We have credit companies as a great role, particularly in the capital market. As we are growing now under the new leadership in Securities and Exchange Commission, and for a bigger financing need, currently we are very much dependent on the banking industry or financial market. But we need to move a longer term investment portfolio from the capital market. I think regulatory changes is needed to give the credit companies more authority to work in a quality form. That I must say. So that is really needed. And also, I think the education is also needed. People has to understand the requirement of the rating. We should not only blame to the auditors that they have done a wrong job, that is why the whole thing has crashed, or only blame to the auditor rating company that they have done these things, so it's all crashed. That perception has to be changed by all of us. That it's everybody's role to give a proper analysis, give a proper report for the investors to feel confidence on the capital market.
Right. Mobin, we obviously need a robust regulatory framework.
Yes.
But then at the same time, as with any industry, the regulatory framework needs to be robust, like I said,
Yes.
comprehensive, yet
Yes.
it cannot be overburdensome. Because regulation can become overburdensome to where it just does not make sense anymore. So it's a balancing act. We must have overarching regulatory mechanisms, so make sure that everyone can take comfort in all the checks and balances are there. But then at the same time, cannot be overburdensome, right?
No, agreed.
Absolutely.
Agreed.
So, Sayaqua, any closing remarks that you would like to add to this discussion?
So, first of all, it was a very insightful discussion, of course, and talking about the challenges and the solutions we are discussing. First of all, as Mobin sir said, of course we need a regulatory regulatory guidance and framework. But along with that, there are some challenges that we are facing for a long time. Like for example, we don't get information from the CIB about the client's repayment history, and it's very important for our assessment. So this is something that can be that Bangladesh Bank can consider to provide us the CIB report. Then secondly, another problem that we face often is that if a client is under surveillance of a particular rating agency, we cannot get information that if it is under surveillance of another rating agency or not, because there is no central database. So maybe the regulators can consider of preparing a central database where we can identify if a client is under another rating agency's surveillance. And finally, and very importantly, the awareness that needs to be developed amongst the clients and the bankers. They need to understand the importance and application of credit rating so that we can have better creditability, and we can help the stock market as well as banks help, and as at the end of the day, the overall economy's health, we can diagnose that and help them to develop their health.
Talking to both of you, it is pretty clear that there is a lot of regulatory help that is needed to make the industry grow robust. And also another thing that I noticed both of you mentioned is that a general awareness is needed, that this is not something that it should be considered burdensome. This is absolutely needed.
Yes.
This is something that is essential, part and parcel of doing business.
Rating companies in their process, they should be independent. That also goes to the audited financial statements, where we also feel independency is a must. No influence from the management side to distort these things. So if they both get their independency, I think situation will be even much better to the general people.
Your work starts based on the audited financial statements. Then you take it from there. So what if the audited financial statement is no good? So lots of areas needs to be looked at. I would like to wrap it up right here with, of course, an invitation, that I would like to go into more specific areas at some future date. I think these are things that everyone should have an understanding of, companies as well as consumers, as to the importance of credit rating and why it is needed. So I thank both of you for your time. It's been wonderful. And with that, ladies and gentlemen, I'd like to thank you for joining us in this session, with an invitation to join us again next week for our next session of Informally Formed. With that, stay safe, and I will see you next week. Bye-bye.